Welcome to day 2 of our Christmas countdown series. Yesterday we talked about the global economy, and today we open the window on the big debate of the hour, interest rates. Right now, markets think they know the script. The Fed cuts a little at the next meeting, which is tomorrow, and say 25 basis points, and then trims a little bit more into 2026. A gentle, controlled easing cycle. Nothing dramatic. We're not so sure it will be that neat. The global economy is being pulled in two opposite directions. On one side, we have a more inward-looking world, deglobalization, tariffs, reshoring. All of that pushes costs up and risks structurally higher inflation and higher long-term rates, of course. On the other side, several years of higher inflation and higher rates have squeezed households, especially in the developed world. Cost of living pressures are real. That hurts demand and slows growth, of course, and creates political pressure to cut interest rates. So central banks are stuck between structurally higher inflation risk and cyclical growth weakness. And then on top of that, layer on a two-speed economy, especially in the US. The AI and the hyperscaler ecosystem is still spending aggressively, almost in its own world. Meanwhile, the real economy, housing, small businesses, lower income consumers, is much closer to stall speed. And in that mix, the surprise is not that the Fed cuts. The surprise is that they may have to cut more than the market expects. Not because they've won the war on inflation, but because growth cracks. And cuts driven by weakness are usually not a bull market story for risk assets. They tend to be a warning signal, not a celebration. We'd put the probability of more cuts than consensus at about 7 out of 10, but for the wrong reasons. And who benefits in that scenario? High quality bonds, treasuries in particular, and especially longer duration, which can also help cushion portfolios if growth does roll over. Come back tomorrow for day 3 when we stay with fixed income and dig into what this means for the bond market. This is Sunil Garg from Keen Eye and Lighthouse Canton.